Okay, second part. So if the new equity capital is sold to U.S. public but by foreign company, we call it Yankee stock offering. So it's like Yankee bond. Yankee bond is a foreign bond in the United States. Yankee stock is the foreign stock in the United States. Since the beginning of the 1990s, the many foreign companies, especially Latin American company, have listed their stock on the U.S. exchanges to prime the U.S. equity market for the future Yankee stock offerings. And there are basically three factors. The first one is the privatization. So South American companies, Eastern European companies usually are the government-owned company, especially the Eastern European the government before 1990 was the communist country, right? So they basically own everything. Now they privatize it. One of the factors that may fuel by the Yankee stock is the pushes for privatization. The second factor is the growth factor. So the rapid growth in the economies of developing countries. So that's why the more foreign developing countries company want to come to the US to finance. I mean, it's possible that, I mean, we saw the reasons in the previous video clips, right? The previous slide says that, well, the company from the developing country basically has limited resource in their own country, so they can actually expand their firm to the US because of the financing source of the US is more broad. And the third reason is about NAFTA. So equity sales by Mexican firms try to cash in the following implementation of the NAFTA. So there's large demand for new capital by Mexican companies, like following approval by NAFTA. So that's why US investors have bought and sold large amount of foreign stock these days. So the typical form of the trading of foreign stock is called the American Depository receipt. The problem of the listing firm in the United States, for the foreign company's perspective, is it's very costly job if they have to file everything in the US too. So such as if the firm is listed in Tokyo Stock Exchange, they meet the requirement in Tokyo and they filing everything to Tokyo Stock Exchange. But if they also want to list the firm in the US, probably they hesitate to do so if they would, they would be required to file same filings as the U.S. domestic firm. So instead of that, they usually trade it as a form of the American Depository receipt. This is called ADR. Very popular. So ADR. So ADR is the foreign stocks often traded on the U.S. exchanges. It's basically a receipt that represent the number of foreign shares that are deposited at a U.S. bank. So basically, same as the stocks, the bank serves as a transfer agent for these ADRs. So what is the advantage of the ADRs? There are a number of advantages. We have 2 slides about that. Now, ADRs are denominated in dollars, traded on U.S. stock exchange, and can be purchased through investors, regular brokers. So you don't have to make, like, you want to invest foreign stock, you want to invest like Japanese stock, you don't have to go to and open the Japanese stock account there, like broker account there. You only just open the account in the United States and they trade in US dollars as regular, the trade you can buy. That's big benefit. Dividends received on the underlying shares are collected and converted to dollars by the custodian and paid to the ADR investors. So you don't have to convert dollars on your own. ADR investors receive the full dollar equivalent dividends, obviously, right? Less only for applicable taxes. So tax issues is solved. You don't have to file on your own one too either. ADR trades clear in 3 business days as do US equities. So it's obviously very fast. And they're price quoted in US dollars. So you can make a trade decision based on the US dollars, not the Japanese yen or euro or UK sterling. ADR, except the Rule 144A issues, so except the private placement, are registered securities, right? So it gives the investor a protection of the ownership rights. It's registered. An ADR investment can be sold by trading a depository receipt to another investor in the United States stock market, or the underlying shares can be sold in local stock market too. So I mean, either in the US or in local market like Japan or UK, you can trade. So you don't have to worry that, well, you cannot sell it in the US because it is basically traded in the US market too. ADRs frequently represent a multiple of the underlying shares rather than the one-for-one correspondence. It allows the ADR to trade in price range customary for the US investors. So it means that, well, some stocks, foreign stocks, may be too cheap or maybe too expensive, so that it's not very attractive price range. I mean, it doesn't have to be just one by one. So you can make this a more attractive price range. ADR holders give instruction to the depository bank as to how to vote the right associated with underlying shares. So for underlying shares, you have voting right. You don't have to worry about like getting the Japanese written the proxy statement so that you cannot make decision. You are guided by the bank, depository bank. So don't have to worry. So there are two types of ADR. One is the sponsored ADR. So sponsored ADR is the one created by a bank at the request of the foreign company that is issued the underlying security. So there's a sponsoring bank and offer ADR holders an assortment of services, including the investment information, portions of annual report translated into English so that you don't have to worry about translations. Like Japanese firm, you don't have to know Japanese languages. It is translated into English and provided. And sponsored ADRs are the only ones that can be listed in the US stock market based on the regulation. So all ADRs in the US right now, newly issued ADR, basically, listed ADRs are this sponsored ADR. But there's also unsponsored ADRs too. It is usually created at the request of the US investment banking firm without direct involvement by the foreign issuing firm. So they may not provide investment information or financial report. It is not allowed now, but there's some dating back prior to 1980 still exist, because the old one, before the regulation, it may be possible. So there's some unsponsored ADRs, which is not very common right now. Now, global registered shares is called a GRS. It's a little different to ADRs. So there's a case that we actually have to have this one. In 1998, Daimler-Benz AG, so it's a Mercedes actually company, and Chrysler Corporation were merged. I mean, they separated later on actually. Now Chrysler is go to the Fiat group, but that time they merged. And they created Daimler Chrysler AG. It's a German firm. And this merger simultaneously created a new type of equity shares because Daimler-Benz AG are listed in Germany, and Chrysler is listed in the United States. So these equity shares called the GRS, Global Registered Shares. GRS are traded globally. Okay. And the company was renamed Daimler AG in October 2007 when it basically separated with the Chrysler. So they basically spun off the Chrysler. And the primary exchange for Daimler GRS are now Frankfurt Stock Exchanges and the NYSE. However, they're traded on a total 20 exchanges worldwide. So it doesn't really mean that they are listed in these exchanges, but they are listed other exchanges globally. The shares are fully fungible. The GRS purchase on one exchange can be sold on another. They basically trade on both US dollars and euro. So this is called the GRS. So what is the advantages and disadvantages relative comparing with ADRs? So the advantage is now all shareholders have the equal status and direct voting right. There's no bank involving, with your trade. It's a direct voting right, direct status, like owner status. But it generates greater expenses because it has to establish the global register and clearing facility. So it's more expensive. Now there's some GRS too. Deutsche Bank, UBS, and NYSE Euronext also trade as GRS right now. So there are another types of the global, the trading, global listing. So there's some empirical findings about ADRs. So internationally diversified portfolio of ADRs outperform usually both a US stock market and the world stock market benchmark on a risk-adjusted basis, which is good, right? For most stocks, the home market price and the ADR price within the 20 to 85 basis point, which means that if the stock price in home market and ADRs are far different, then there should be an arbitrage opportunity, right? You can buy cheaper price and sell by higher price. The difference is pretty minimal, so that it never over the transaction cost, so limiting any arbitrage opportunities too. International stock indexes. So these indexes constructed and published by MSCI. I mean, there are many international stock indexes, usually MSCI construct and publish this excellent source of national stock market performance. They have data for 23 national market indexes from developed country, 24 emerging market, and 32 frontier markets. So they categorize this market as like the developed country, emerging market, and the frontier market. And these are the list. I mean, I don't know how many of them actually, many, right? And there are indexes here, and there are countries. So there's so-called iShare MSCI. So BlackRock Incorporated, you probably heard this company, BlackRock. This is international investment management firm. Operate this iShare MSCI as a vehicle to facilitate investment in country, regional, and world funds. So what is this? This iShare MSCI are the basket of stock designed to replicate the country index of the 22 countries. These iShare MSCIs are exchanges traded funds. So these itself are the funds that you can actually trade where on American Stock Exchange and subject to US SEC IRS diversification requirements. And this requirement prohibits the investment of the more than 50% of the funds in fiber fewer security or 25% of the funds in a single security. So some funds may not perfectly replicate their respective MSCI index. Actually. So you can trade these iShares. It actually has a lower cost and it's very convenient way if you want to hold a diversified investment in several different countries, because it represents 22 countries now. So it is traded. You don't have to buy individual stock. You can actually buy iShares MSCI. So what is the factors that affect international equity return? It's very hard, actually. No. So these are the factors we may consider: macroeconomic factors, exchange rates, and industrial structure. And these are the findings from several empirical studies, many empirical studies. First, macroeconomic factors. Now, international monetary variables have only weak influence on the equity returns in comparison to domestic variables, which means that domestic variables are more important, okay? So equity returns are weakly influenced by these international macro factors. What about the exchange rate? Exchange rate actually affect bond market stronger, equity market weaker. But it also showed that hedging foreign stock investment against exchange rate uncertainty is very beneficial. So you need to hedge against the exchange rate risk. The third factor, industrial structure. Well, the influence of industrial structure on foreign equity returns are very inconclusive. So there's no really clear evidence that industrial structure may affect the foreign equity returns. So as we saw in the several empirical studies that test for factors that might influence equity returns, they indicate that domestic factors such as the level of domestic interest rate and the expected changes in domestic inflation had a greater effect on national equity returns, not the international monetary variables. Industrial structure did not appear to be of primary importance. Equity returns were also found to be sensitive to own currency exchange rate changes, which means that the hedging against this exchange rate risk is very beneficial again. All right, so this is the end of the chapter 13, international equity market. Thank you for watching chapter 13. Goodbye.